Hedge FX, interest rate, and commodities exposure. Hedging foreign exchange, interest rate, and commodities exposure is a vital treasury responsibility because fluctuations in financial markets can significantly affect organizational cash flows, profitability, and financial stability. Treasury professionals identify, measure, and manage market risks arising from international operations, borrowing activities, and commodity consumption or production. The objective of hedging is not speculation, but the reduction of uncertainty and protection of financial performance from unfavorable market movements. Treasury teams establish risk management policies that define acceptable exposure levels, approved hedging instruments, and governance procedures. Effective hedging supports predictable earnings, stabilizes operating cash flows, and improves strategic planning. Treasury professionals continuously monitor market conditions, economic indicators, and organizational exposures to implement risk management strategies aligned with corporate financial objectives. Foreign exchange exposure arises when organizations conduct transactions or maintain assets and liabilities denominated in foreign currencies. Treasury professionals manage transaction exposure, translation exposure, and economic exposure using both operational and financial hedging strategies. Common financial instruments include forward contracts, currency swaps, options, and futures contracts. Forward contracts are widely used because they lock in exchange rates for future transactions, reducing uncertainty regarding settlement values. Treasury teams may also implement natural hedging strategies by matching foreign currency inflows and outflows or financing operations in local currencies. Effective foreign exchange hedging reduces earnings volatility, protects international cash flows, and improves financial predictability. Treasury professionals must also evaluate counterparty risk, settlement timing, and regulatory considerations when executing foreign exchange hedging transactions. Interest rate exposure affects organizations with floating rate debt, variable rate investments, or planned financing activities because changes in interest rates influence borrowing costs and investment returns. Treasury professionals analyze yield curves, central bank policies, inflation expectations, and market conditions when evaluating interest rate risks. Common hedging instruments include interest rate swaps, caps, collars, and futures contracts. Interest rate swaps allow organizations to exchange fixed rate and floating rate payment obligations, helping stabilize financing costs and align debt structures with risk management objectives. Treasury teams evaluate hedge duration, pricing, and potential cash flow impacts before implementing strategies. Effective interest rate hedging reduces exposure to market volatility, improves budget forecasting accuracy, and strengthens long-term financial planning and capital structure management. Commodity exposure arises when organizations depend on raw materials, energy products, agricultural goods, or metals whose prices fluctuate significantly due to market supply and demand conditions. Treasury professionals in commodity-sensitive industries monitor market trends, geopolitical events, weather conditions, and production disruptions that may affect input costs or revenue stability. Commodity hedging instruments include futures contracts, options, swaps, and forward agreements that establish predetermined purchase or sale prices. Treasury teams analyze operational consumption needs, production forecasts, and pricing risks when developing hedging strategies. Effective commodity hedging protects profit margins, stabilizes production costs, and supports reliable financial forecasting. Treasury professionals must also consider liquidity requirements, hedge accounting implications, and counterparty exposures when managing commodity-related financial risks. Risk governance and hedge effectiveness monitoring are critical aspects of Treasury risk management programs. Treasury professionals establish policies defining hedging objectives, exposure limits, approval authorities, and reporting requirements to ensure consistency and regulatory compliance. Treasury management systems provide visibility into market exposures, derivative positions, valuation changes, and hedge performance across organizational operations. Treasury teams regularly evaluate whether hedging activities effectively offset underlying risks and remain aligned with organizational objectives. Hedge accounting standards may also influence strategy selection because accounting treatment can affect reported earnings volatility. Strong internal controls, segregation of duties, and documentation procedures are essential to reduce operational and compliance risks associated with derivative transactions and financial market activities. From a CTP examination perspective, candidates must understand the principles, instruments, and strategic applications of hedging foreign exchange, interest rate, and commodity exposures. Exam questions frequently assess the ability to identify market risks, evaluate hedging alternatives, analyze derivative instruments, and recommend appropriate risk management strategies under changing economic conditions. Candidates should understand forward contracts, swaps, futures, options, and natural hedging techniques, as well as the operational objectives of hedging programs. Knowledge of market volatility, hedge effectiveness, counterparty risk, and accounting implications is also essential. Treasury professionals must recognize how hedging supports financial stability, protects organizational cash flows, and enhances long-term strategic planning and risk management effectiveness across global business operations.